What if the order in which you've bought your insurance is wrong? What if you've got the wrong insurance at the wrong time? Well, in this video, I'm going to share the order in which you should buy your insurance. I'm going to help you by showing you some insurance you should avoid. I'm going to give you some helpful tips to help you save money on your premiums. Did you know, for instance, that over 25% of people have never ever shopped around for insurance? They fill out one quote and that's it. But 76% of people could save money if they did so. I'm Stuart Duncan and welcome to Everyday Personal Finance. So as always in these videos, I'm going to give you the bottom line up front. Here is the order in which you need to buy your insurance. 1. Medical insurance. Medical health, medical aid, health cover, whatever it's called in your country, plus gap cover if it applies. 2. Income protection. 3. Life insurance or life cover. 4 and 5, because they usually go together, buildings and contents insurance. 6. An all-risk cover for portable items. 7. Car insurance or motor insurance. 8. Critical illness cover, or as it's unfortunately sometimes known, dread disease cover. 9. Legal expenses. And then there's some insurance that depends on your lifestyle and what you do. So that would be pet insurance, travel insurance, and business insurance. In addition to diving deep on all the items in this list, we're also going to be going through things to avoid and some money-saving tips that we can look at to reduce our premiums. I want to put a big asterisk next to the whole list, though. And this is sort of a disclaimer. Insurance is very personal, okay? It depends a lot on your lifestyle, on your priorities, or your stage in life. So my advice would be, if you are at all concerned or if you have any questions, seek out a financial services professional. Somebody who has your best interests at heart and somebody who knows you and knows your personal situation. Right? This is not financial advice. It is here for an educational perspective. Also, the laws and the rules and the products available in different countries can change. I'm based in South Africa, so I'm going to look at it, or try to be as global as possible, but there are some items that are specifically South African. So forgive me for that, but the majority of the information in this video will be globally applicable. All right, let's start. Number 1, medical aid or health cover or medical cover or health insurance, plus gap cover. Now, I'll speak to both of these individually. So your health is, firstly, the most important thing that you have limited control over. Right? You can eat healthily, you can exercise, that sort of thing, that's fine. But big ticket issues, big diseases, big illnesses, big injuries, big accidents are typically outside of your control for the most part. And for those huge things that impact you massively, you need to have cover. So your health insurance is by far the most important type of insurance that you can get. Now, some countries do have publicly available health insurance. So the NHS in the UK, for example, Medicare in the US, and these might be more applicable to you. Or you might want to bolster their provisions by getting your private health insurance. Research that within your local environment, because you have to make sure that your health cover is firstly suitable for you, for your age and what diseases and issues you are likely to face. It's suitable for your situation, so your present injuries, for example, that might need to be featured in your health insurance, and the level of cover, and in that, by that I mean your things like wait times, for example. I lived in the UK for 10 years, and I know that wait times on the NHS are ridiculous, right? You need a hip replacement, for example. If you don't have private healthcare, you are waiting 6 to 12 months. It's 2025 at the moment, and that is definitely accurate because a member of my family is waiting for one. All right, and if she didn't have private healthcare, which she does, she would be waiting 6 to 12 months. On private healthcare, it's a matter of weeks. These are things you need to consider. Gap cover. Gap cover isn't health insurance per se, it is insurance on your insurance. So if your insurance doesn't pay the full amount, your gap cover will cover the gap, hence the name, between what your insurance provides and what the hospital charges or your provider charges. It tends to cover the same stuff as your health insurance. So if your health insurance paid a portion, your gap cover will cover the remaining portion. If your health insurance doesn't insure it, like if you want to go and do aromatherapy and try to claim that on your health insurance and it's not covered, your gap cover is not going to cover it either. Okay, so just bear that in mind. Number 2, income protection or disability cover. Income protection is, as it states, there to cover your income. Your ability to work overtime is your most important asset. So this asset needs to be protected. It needs to be insured. And this insurance product is there to do that. What it does is it replaces your salary or your wage if you get injured or if you have an illness. I'll talk about the difference between critical illness cover and income protection, because there is a difference. But basically, your income protection is there to make sure that you can still earn money if you are unable to do your job. The big impactor for your premiums on this insurance product is the amount that you're covered and the waiting period. It's typically a percentage of your salary, so let's say 70%, because there are some costs associated with going to work, which would fall away. The other side to this is your waiting period. How long do you have to wait until taking this cover? And that typically depends on your work. How long can you have medical leave until you stop receiving a salary? So check with your workplace, see what that benefit looks like. Because obviously if you can stretch that out, your premiums will be lower. Next is life insurance. Life insurance is probably one of the more controversial types of insurance. It's not controversial in terms of its requirement. It's definitely a priority. You need to insure your life. It's controversial in that there are two main types. So you've got whole life insurance and you've got term life insurance. Whole life is as it sounds. You are insured for your entire life. It's typically more expensive and there are a lot more caveats to it. Term life insurance is a bit more straightforward. You are insured for a term of your life, so a period of time. So why do these two separate products exist? Well, typically, when you imagine life insurance, you would imagine that your life is what is insured. And when you die, you get money, or your estate gets money. But in actual fact, if we dive a little deeper into that, that money goes to paying off your debts and helping support your dependents. So that requirement isn't your entire life, because you don't have debts your entire life, hopefully not, you pay things off, and your dependents aren't dependent your entire life. So my opinion is that term life insurance, in other words, where you're insured for a period of time, 20 years, 30 years, is more applicable to the majority of people. This also goes back to what I said at the beginning, in that insurance is a very nuanced product. If you are a student and you have no dependents, life insurance is not a priority for you, because if you die, no one is impacted. Sure, people will be sad, it'll be an emotional thing, but no one is financially implicated in that, right? So insurance is not a priority for you at that stage. Similarly, as you get older and you no longer have a mortgage that needs to be paid off, you no longer have kids that are living off your salary, they're having their own lives, insurance of that scale is no longer necessary, so you can scale back. Right, so think about term insurance. I would avoid whole life insurance. And the other nuance here is your insurance should pay your estate. Right? Don't take insurance that is linked to a bank. Very often, insurance is acquired on your house. When you take out a mortgage, you need to have some form of life insurance so that the bank knows that that is going to come in if you die. But take out your own insurance on this, because bank-based insurance is expensive. It's always cheaper to get your own insurance on this front, and it pays you. Very often the bank insurance pays the bank first, and then you get the remainder. So just a little caveat on that. So the question is, how much should I insure on my life insurance? Well, the rule of thumb is all of your debts, so your mortgage, if you have car debts, if they're credit card debts or something like that, but all of your debts, plus 10 to 15 years of expenses, right? So you should know your monthly expenses, because you've done a budget, multiply that out. And that's roughly how much you need, all right? It's, again, not exact, it's just a kind of a rule of thumb. Speak to somebody if you're in any doubt, a professional who knows your situation. 4 and 5 are buildings and contents insurance. I'm going to speak about these together because they are typically bundled together and sold as a package. And we'll talk about bundling at the end, so stick around for that. Buildings insurance is, as it sounds, you are insuring the building in which you live. So if you have a freehold structure, as in a house with 4 walls that are separate, then you typically have insurance that covers your building. Note, it is covered for replacement costs. The disaster that it is insuring against is, say, a fire where your house burns down. You still own the land, you don't need to buy the house again, you just need to rebuild, all right? So that's what your building is insuring against, that's the disaster. Okay, it's also insuring against things that impact your house, like a roof issue or major leaks, that sort of stuff, things that impact the building itself. Right, so make sure that you have cover for that. A note on this: you might have area specific requirements. So if you live on a floodplain, for example, you might need flood insurance, or if that is a big issue, that could be quite expensive. Likewise, if you live in a hurricane prone area or a tornado prone area, that type of insurance might be a bit more nuanced. So do your research on that for your specific region. Contents insurance, as I said, typically bundled with buildings insurance, and as the name suggests, it insures the contents of the building. These are things like your appliances, your furniture. It does not include stuff that leaves the house, so things like your laptop or your mobile phone. That is covered under all risk or portable insurance. So we'll address that next. This type of insurance has something called new for old, typically, where your old stuff is replaced for new stuff. And you need to make sure that those amounts are accurate. So you are replacing the right sofa, you're replacing the right fridge, you're replacing the right geyser system. It needs to be accurate, right? So you need to have accurate valuations of your sofa, your fridge, your geyser in order to replace this, all right? Make sure that those numbers are correct. All risk or portable insurance or specified items, if it's included in your contents insurance, this is obviously for your items that are portable, your laptop, your mobile phones, your jewelry. We want to prevent the loss of these items impacting our lives. So if it's your laptop or your phone, you need to be able to work, so that needs to be replaced quickly. Your jewelry, that sort of thing, if it is incredibly sentimental, replacing that sentimentality is going to be very, very difficult. So think about insuring specific jewelry. If it is jewelry that is worth a lot, insurance makes sense. If it is jewelry that is sentimental, insurance might not make sense because the value of it is irrespective. The numerical value of it is not the same as its sentimental value, right? Some things you just can't replace. So insurance might actually not make sense on some items. Think about that. And again, consider your own personal circumstances. Number 7 is car insurance. Obviously, if you don't own a car, this is less important. Although you can still get third-party car insurance if you drive someone else's vehicle, and that protects you from the cost of replacing or repairing other people's vehicles if you're involved in a collision. This insurance has comprehensive or partial cover to it. So if you require that car all the time and losing that car would be significantly detrimental to you for your work or your family life, go with comprehensive, and preferably something that includes a hire car or a loan car as complementary. If, however, the car is really old, you don't use it very often, you could then adjust the coverage to say that the value of the car is low enough that I could probably replace it from, say, my emergency fund if I needed to. Things like that are very nuanced on your specific circumstances, so check that out. Critical illness cover is number 8. Or as it's darkly known, dread disease. And dread disease cover is there to cover you if you get one of a list of diseases. So it's things like heart attacks or cancers, or if you lose the ability to walk, that sort of thing. It is not an ongoing payment like your income protection. It is a once-off payment used to cover changes to your lifestyle that you have to make. So things like adjusting your home for putting in ramps for wheelchairs, or getting in support to cover you while you're ill, that sort of thing. So it's a once-off lump sum payment. Number 9, legal expense cover. This is, I would feel, a bit of a luxury and can often be covered by your emergency fund. But if you are in a situation where this could happen to you relatively easily, or you're in a particularly litigious society, people who like to sue other people, this might be worthwhile to get. As it says, it's to help you with dispute costs and attorney fees, and it is, in its defense, see what I did there? It is typically quite a low-cost item to add on to some sort of general insurance policy that you get. The next 3 I'm going to kind of bundle into this situational dependent insurance. The one is pet insurance. If you don't have a pet, you don't need pet insurance, obviously. However, pet bills can be surprisingly expensive, as I'm sure any dog owners can tell you. And if these bills would cause you quite a bit of financial strain, or you have a particularly injury-prone pet or an expensive breed, maybe this is the type of insurance for you. But bear in mind, if your pet is injury prone, you will pay for that extra risk. Likewise, the insurance companies know the types of pets that are likely to require cover. Travel insurance. If you don't travel, you don't need it. Two main types here, multi-trip and single trip. Multi-trip tends to last you for the year. If you're going to travel a lot in a year, that's definitely the one for you. If you just travel once off, take the once off. Don't take multi-trip thinking, oh, I'm definitely going to take 3 trips. Unless they're planned, single trips works out financially better for you. Within these, I would focus on evacuation and medical cover. That's the most important thing that could happen to you. An added item that they tend to tag on here is trip cancellation cover. I would only get this if you couldn't self-insure this. In other words, cover those losses within your emergency fund. It's typically not worth the money because most places will reschedule or cancel if you have, some sort of plane malfunction or there's some sort of weather event that prevents you from leaving or having your flight cancelled. So most places would accommodate that. So it's an added luxury. Business specific cover. So this is got the biggest star next to it. If you have a business, you might require this type of insurance. So if you're a plumber, you might require liability insurance. If you're a solicitor, you might require public liability insurance or malpractice insurance. It might be part of it. So this would then be right at the top of the list. So a caveat on that. My advice here is do your research around your business risks. Those risks tend to have insurance products linked to them. If you're a landlord, there's a risk of renter default. You can take out insurance against renter default. Likewise, you can take out insurance against your tenants damaging your property. If you're, again, a plumber, you can take out insurance against your tools being stolen, right? So this is business-specific insurance. Do your research and protect your income. Okay, what to avoid. We've covered everything that you should get. Now, what should you not get? Number 1 on this list is extended warranties. Extended warranties are typically not worth the money. The chances of a new product breaking in that warranty time frame is very, very low statistically. Extended warranties, I would avoid. Payment protection insurance. There was a spate in the UK where payment protection insurance was sold with new credit cards, with new home loans, as a compulsory item. And what it essentially does is it protects the lender from you not paying, right? And you paid for that privilege, right? It was a big hoo-ha. Lots of people were refunded a lot of money. Payment protection insurance typically has a very low payout and it doesn't really benefit you. I would advise skip the payment protection insurance. Mentioning here again, travel insurance or airline insurance, and this is the stuff that you get from a travel agent where they say, oh, would you like to get insurance? That insurance is typically way more expensive than if you were to get your own travel insurance, right? So always do your own research on insurance deals there. Specialist gadget insurance. Don't take this. Simply roll these items under named items in your contents insurance. It is more expensive to take out a insurance policy for one specific thing than it is to have a larger contents insurance policy and have these things listed there. So that's some advice on that front. Funeral policies. These are very popular in some areas of the globe. In South Africa, they are very popular, but they have interesting features that make them unattractive, in my opinion. They are capped in my country at 100,000 Rand, which is more than your average funeral. The funerals here typically range between 30 and 80,000 Rand. But the point is you can easily self-insure that amount of money. You could build up an emergency fund that could go to that, and it could be in more than one person's name so that they can access that fund. Funeral cover is typically not worth the money when considering you can self-insure or bundle this in with, say, a life insurance policy or a will. It's much easier to do that way than having standalone funeral cover. Before I get into some money-saving tips and tricks, if you've enjoyed this, if you found value in this, hit that like button. It really does help. It means the world to me. And if you want to be informed of any more videos, hit that subscribe button and bang the bell icon. Right, how can we save a little bit of money without reducing our cover? First way you can do it is to increase your deductible, or your excess as it is known. If you have built out your emergency fund, this makes sense because you can cover the difference between what you need and what is insured using this money. That's kind of a way of semi-self-insuring. You'd be surprised at how much this slashes your monthly premiums. And you can then use that difference to invest and help further self-insure. And remember the point of insurance. It's there to protect you from financial ruin. So having a high deductible doesn't necessarily change that fact. Minimize your extras. We pay a lot for peace of mind in insurance, and that's what the industry plays on. However, if you can live without your phone or your laptop for a while and you could self-insure those, maybe skip on gadget insurance as an example. Focus on catastrophic loss for your insurance. Reassess every year. We pay hugely for complacency. Are your building sums set accurately? Is the value of your property correctly insured? Have you changed the contents in your house? And a note on that, take photographs of all of your named items. You need to know exactly what you have insured and include warranty and serial numbers on them. Keep a spreadsheet with a list of items that are insured with all of their details. Check for duplicates. So do you have gadget insurance and those items are insured under your contents insurance? That's a duplicate. Scrap one of them. Is your life insurance and your will, do they both provide funeral cover? Pick one, stick with that one. And then once you have reassessed, shop around, get different quotes, and then go back to your insurance provider and say, these are my different quotes. I'd like you to match that, please. The majority of insurers want to keep you and they will do a retention match. If they don't, it might not have been the right insurer for you. There is no such thing as loyalty in insurance. It does not pay to be loyal to your insurance provider. Shop around, be ruthless. Bundling. I mentioned bundling contents and home, for example. You can pair insurance products together. It often pays to have your car, your buildings, your household, your portable, all under one insurance provider. It gives you more power as well when you renegotiate because you'll take all of that to another insurance provider. But also they tend to know you so they can de-risk all the products because of you being a known quantity, right? So think about that for your insurance product. Lastly, cut risk. Show your insurers you are low risk. Simple things like alarms, vehicle tracking devices, even sensors in your roof that detect water leaks. All of these things can drop your premiums. Speak to your insurance provider, ask. It pays off in the long run to do it. These aren't about cutting corners, they're about cutting waste. Save where it makes sense and keep your money focused on covering what matters, the big risks. That's what insurance is there for, to protect you from catastrophic financial loss. Here's the takeaway. Big things first, skip the junk, and use smart tricks to cut your costs. There's a link below for you to download the insurance cheat sheet. And once you set a goal this week of solving 2 insurance gaps that you've currently got. Thank you very much for joining me. And if you got some value out of this, hit that subscribe button for more information just like this coming your way. I'll see you again next time. Cheers. Did you know that over 25 people, definitely not, more than that, it behooves you to protect your business. Don't use behooves, that's a ridiculous word to use. It's very important. Wow, that's so disgusting.